Think you know how to make money in real estate? What if I told you most investors make 5 huge mistakes, and you might be making them too? Keep watching to avoid losing your hard-earned cash. Investing in real estate can seem like a gold mine, but many new investors end up hitting roadblocks that could have been avoided. Whether you're eyeing your first rental property or looking to expand your portfolio, it's easy to fall for common mistakes. These errors can cost you big time, not just in money, but in wasted opportunities. In today's video, we're breaking down the 5 biggest real estate mistakes that rookie investors make, and more importantly, we'll show you how to avoid them so you can thrive in the market. Real estate investing isn't as simple as just buying a property and collecting rent. The real danger is that a single mistake can undo all your hard work. With so many moving parts, from financing to market research, it's easy to feel overwhelmed. The problem is that many new investors rush into deals without understanding what can go wrong. The result? Losing money, missing out on better opportunities, or even facing foreclosure. So how can you avoid this fate? It all starts with understanding the mistakes others make and how you can avoid them. Mistake number 1. Not doing enough research. The first and possibly most dangerous mistake any real estate investor can make is not doing enough research. There is so much more to real estate than finding a nice property at a good price. A lack of proper research can lead to poor investment decisions, and if you're not careful, you might lose everything. When we talk about research, we aren't just referring to a quick Google search. Successful investors spend a significant amount of time studying every aspect of the market before they even think about making a purchase. There are several key areas you should research before investing in any property. Market trends. You need to understand the current market conditions, whether it's a buyer's or a seller's market, and how they affect property prices. Is the market growing or declining? What does the future hold for property values in the area you're targeting? Researching the long-term trends will help you avoid investing in a property that could lose value in the coming years. Local area. The location of your property is one of the most important factors to research. You need to know about the neighborhood's crime rates, schools, amenities, and future development plans. A great property in an area with a rising crime rate or where a new highway will cut through could be a bad investment, even if the property looks perfect on paper. Comparable properties. Analyzing similar properties in the area will give you a good sense of the fair market value for your investment. Are other properties in the area appreciating in value, or are they stagnant? This will give you a better idea of what you can expect in terms of resale value or rental income. Zoning and regulations. Many new investors fail to research zoning laws, especially if they're purchasing a property for redevelopment or multifamily use. These laws can limit what you can do with the property in the future. Additionally, understanding local building codes, rental regulations, and taxes will save you from expensive surprises down the road. Not doing enough research could lead to overpaying for a property, buying in the wrong location, or purchasing something with hidden problems. This mistake alone could cost you thousands of dollars, so take the time to gather all the relevant information before jumping into any deal. Mistake number 2. Ignoring the numbers. One of the biggest traps new investors fall into is ignoring the numbers. Real estate investing is about making money, and that means you need to be able to analyze the financials thoroughly. Simply getting caught up in the excitement of owning a property can blind you to the reality of how much the investment is really going to cost, and how much it will generate in return. This mistake often happens when investors focus too much on the idea of passive income without really understanding what goes into achieving it. There are many financial factors to consider when evaluating a property. These include return on investment, or ROI. The ROI is a critical metric for determining how much profit you're making in relation to the amount of money you've invested. Without understanding how to calculate ROI, you might purchase a property that costs you more in maintenance and repairs than it generates in rental income. Cash flow. Cash flow is another essential metric. It's the money that remains after all of your expenses, mortgage, property taxes, insurance, property management fees, etc., have been paid. Positive cash flow means that you are earning money each month. Negative cash flow, on the other hand, means you're losing money. Understanding cash flow will help you decide if an investment is worth the risk. Operating expenses. You also need to factor in the operating expenses of the property. These include costs like repairs, maintenance, property management fees, insurance, taxes, utilities, and any other ongoing expenses. Too many investors fail to budget for these, which can quickly eat into their profits. Unexpected costs. Another aspect that is often overlooked is the potential for unexpected expenses. No property is without its problems, and things like a broken furnace, plumbing issues, or a damaged roof can end up costing you more than you anticipated. Many investors forget to build a reserve fund to cover these surprises. This oversight can turn a seemingly profitable investment into a major headache. Make sure to do a detailed financial analysis before making an offer on any property. Know what your income and expenses will be, and understand the long-term financial impact of your investment. You don't want to be caught off guard by hidden costs that eat away at your profits. Mistake number 3. Overpaying for a property. Another critical mistake many investors make is overpaying for a property. It's easy to get swept up in the emotions of a deal, especially when you think you found a property with great potential. However, buying at the wrong price can make it difficult to turn a profit, even if the property is in a desirable location. In real estate, the price you pay for the property directly impacts your ability to make money. Overpaying can lead to higher mortgage payments, more interest paid over time, and an inability to generate the necessary return on investment. Even if you think you've found a gem, overpaying can tie up your capital and leave you with little room for error. So how can you avoid overpaying? Comparable market analysis, or CMA. Before making an offer, you need to look at comparable properties in the area. This is called a CMA. It will help you determine what similar properties are selling for and will give you an idea of the fair market value. If the property you're interested in is priced significantly higher than similar properties, you might want to reconsider. Get a professional appraisal. A professional appraiser can give you an unbiased assessment of the property's true value. This is especially important if you're purchasing a property that requires renovations. The appraisal will give you a realistic picture of what the property is worth in its current condition and whether the asking price is fair. Negotiation. Never underestimate the power of negotiation. Even if you've done your research, there's always room for negotiation. A skilled negotiator can help you secure a better deal by negotiating the price, the terms of the sale, or even additional concessions from the seller. Don't be afraid to haggle and ask for a better price or added value. By being diligent in your pricing research and not getting emotionally attached to a property, you can avoid overpaying and make sure you're getting a good deal. Mistake number 4. Not having a long-term plan. Real estate investing is a long-term game. Many new investors make the mistake of treating real estate like a quick flip or short-term money-making opportunity. But the reality is that successful investors think long-term. Without a long-term plan, you can easily find yourself scrambling for quick fixes or chasing short-term profits that don't yield lasting results. A long-term plan allows you to stay focused on your goals, regardless of short-term market fluctuations or temporary setbacks. Here's how you can develop a strong long-term plan for your real estate investments. Define your investment goals. What do you want to achieve with your investments? Are you looking for rental income, tax benefits, long-term appreciation, or a combination of these? Having a clear idea of what you want to achieve will help you make better decisions down the line. Understanding your financial goals will also guide you in selecting properties that align with your investment strategy. Growth strategy. How do you plan to grow your portfolio? Will you acquire properties gradually or look for high-value, high-return opportunities? Establish a growth strategy that allows you to scale your investments in a sustainable way. Risk management. Real estate is never without risks. Understanding your risk tolerance and preparing for market fluctuations or economic downturns is key. Factor in potential downturns and have contingency plans in place to mitigate risk. Exit strategy. Always have an exit strategy in mind, even when things are going well. Whether you plan to sell when the market peaks, refinance, or pass the properties down to heirs, having a clear exit strategy ensures you're not caught off guard. When you have a well-thought-out long-term plan, you'll avoid making impulsive decisions that could undermine your financial future. Mistake number 5. Neglecting the importance of property management. The final mistake is one that many investors overlook: neglecting property management. Whether you're planning to manage the property yourself or hire a professional property management company, this aspect of real estate investing is crucial. Effective property management ensures your property stays in good condition, tenants are satisfied, and rental income is consistent. Without a proper system in place, you risk costly repairs, unhappy tenants, or periods of vacancy that can eat into your profits. Here's how you can avoid property management issues. Hiring a property manager. If you have multiple properties or live far away from your investment, hiring a property manager might be your best bet. They can take care of everything from tenant screening and rent collection to maintenance and repairs. While there is a fee for their services, it can save you time, hassle, and money in the long run. Managing the property yourself. If you decide to manage the property yourself, make sure you have a system in place for handling repairs, dealing with tenants, and keeping up with maintenance. Utilize software and tools to help streamline the process, track expenses, and communicate with tenants. Tenant screening. One of the most important aspects of property management is tenant screening. You want to ensure that you rent to responsible tenants who will pay on time and take care of your property. Don't rush this process, as the wrong tenants can cause major headaches down the line. Effective property management can make or break your real estate investment. Whether you handle it yourself or hire someone, ensure it's a priority. Now that we've covered the 5 biggest mistakes to avoid, here's the key takeaway. Real estate investing isn't just about finding a property and collecting rent checks. It's about understanding the details, numbers, and long-term strategy that will set you up for success. The real winners in real estate are the ones who take the time to research, do the math, and build a long-term plan. They don't rush into things or make decisions based on emotions. They make sure every move is well thought out and calculated. Avoid these mistakes, and you'll be in a much stronger position to succeed in the competitive world of real estate investing. To sum it up, if you want to thrive in real estate, avoid these 5 mistakes at all costs. Don't skip your research, understand the numbers, be careful about overpaying, plan for the long term, and ensure you have a solid property management strategy. Taking the time to get these aspects right from the start will set you on the path to financial success and growth in the real estate market. Want insider real estate investing tips? Subscribe now and grab the game-changing info in the description.